In this video, you'll learn all about call options using real examples from Robinhood. We'll talk about what a call option is, plus the concepts of intrinsic versus extrinsic value, volatility, and in the money versus out of the money. Part 2 will explain the option Greeks, and Part 3 will explain the Black-Scholes Model. Disclaimer: I want to warn you that call options are not something to mess around with unless you fully understand the risks of what you are doing. They have the capability to make you rich, but they also have the capability to make you broke if you aren't careful. That being said, let's get into it. What is a call option? Let's explain this by telling a little story. It's a beautiful September morning on the first school day of 5th grade, and you're walking to the bus with your friend Ted. Ted is telling you that he just bought a rare Charizard Pokemon card for $5 at the local card store. The more you learn about the card, the more you want to have it. You think this is going to be worth much more than $5 one day. You ask Ted if you can make a deal with him. The deal is that you give him $2 today, which he can permanently keep. That $2 is always his. However, from now until the end of the school year, you can buy the card from him at any time for $5. Ted thinks about it, and his logic is that, well, he's only gaining money from this transaction, so what does he have to lose? He'd get a free $2, then he would also make back his $5 that he got for the card originally. Ted agrees, and you shake on it. Fast forward to Christmas time. There is a Pokemon game on the Nintendo Switch coming out that generates a lot of hype in the Pokemon world. On the cover of the game is a picture of Charizard that looks exactly like the card Ted has. You start jumping with joy because you know this will totally increase the value of Ted's Pokemon card. You check eBay and see that cards like his are now going for $20. The next school day, you tell Ted you would like to buy the card from him. You give him the agreed upon $5 in exchange for the card. After school, you go back on eBay and sell the card for $20 online, making yourself a nice $13 profit. You paid $2 for the right to buy the card at any time during the school year and $5 for the card. You now have more than doubled your money from this deal with Ted. Now, there is some terminology to go over before we apply this example to the stock market. The $2 paid to Ted is known as the options premium. You are paying for the, quote, right but not the obligation, you'll hear that phrase a lot in the options world, to buy the card from Ted at any time. The $5 card price is known as the strike price. The strike price is the agreed upon dollar amount that the underlying asset, in this case the Pokemon card, can be bought for at any time from now until expiration. When is the expiration date? In this example, it was the end of the school year. All options contracts have to have an expiration date. In the stock market, there are many expiration dates ranging from days to months to years. They commonly place these on Fridays. You may be thinking, why not just always make the expiration date as far out as you can? That way, there will be enough time for your deal to pay off. Well, that's where the actual dollar amount of the options premium comes into play. The farther out the expiration date, the more the option premium will be. The options premium price formula is simple. Options premium price is equal to intrinsic value plus extrinsic value. Let's look at Robinhood to calculate some intrinsic and extrinsic values of call options contracts. NVIDIA is trading at $662 per share. The call options contract with an expiration date of February 9, 2024 and a strike price of $650 has an options premium price, which Robinhood calls the ask price, of $19.95. Now, determining the intrinsic value of an options contract is easy. It is simply the current stock price minus the strike price. Doing the math, 662 minus 650 equals $12. Therefore, the specific call options contract has $12 worth of intrinsic value. Since we know the formula for the options premium price equals intrinsic plus extrinsic value, then we can solve for extrinsic value using some basic algebra. The extrinsic value will be $7.95. What do these values signify? Well, the intrinsic value is simply the price you would get if you exercised the call option right this moment. The extrinsic value is a little more abstract, and it is a function of 4 different variables: the time, volatility, interest rates, and dividends. The longer the time to expiration, the higher the extrinsic value. This can be shown here by looking at the February 16th expiration date for the same $650 strike price call option contract. The option premium is now $25.90. The intrinsic value is still $12, but now the extrinsic value, the amount left over, is $13.90. You are basically paying extra money for the ability to see what happens with NVIDIA over 2 weeks as opposed to 1 week, because more time allows for a higher chance of larger price swings. Also, you may hear the terms in the money or out of the money. If an options contract has intrinsic value, it is in the money. If it doesn't, then it is out of the money. Any of these call options contracts under this green line are considered in the money, while everything above the green line are considered out of the money. Okay, we've established that time affects an options premium. What else affects the price of an options premium? Volatility. I have 2 stocks here, Uber and McDonald's. These charts go 5 years back, and actually they both have returned 62% in this time period, which is perfect for explaining this example. The end result is the same, 62%, but how have both of these companies gotten there? Uber has gone down and up and down and back up again, a pretty crazy ride. McDonald's has been very steady Eddie. Yes, there are always fluctuations in a stock, but overall McDonald's stock has been a fairly smooth ride. We would call McDonald's a low volatility stock. On the contrary, Uber is a high volatility stock. All that it means is on any given day, the expected price range for Uber stock would be a much larger percentage change than McDonald's stock. If you had to pick a stock that would increase by 20% in the next month, which would you pick? Uber would be the rational choice because it has shown a history of large price movements. Now, let's select the same expiration dates for both of these stocks, and then we'll see what an options contract will cost that is 10% higher than the current price of each stock. With Uber at $68, a 10% increase would be about $75. The $75 strike price is going for $2.46. For McDonald's, a $10 increase puts the price at roughly $330. The call options contract here costs $1.05, less than half of the apples-to-apples comparison with Uber. Again, the reason is volatility. The higher the volatility, the higher the extrinsic value, and therefore the higher the options premium price, because options premium equals intrinsic value plus extrinsic value. We now have somewhat of an idea of what a call options contract entails. There's an options premium price, a strike price, and an expiration date. Let's now try to piece our way through a potential purchase of a call options contract. Currently, Apple is trading at $185.11 per share. Opening the options chain, for now only focusing on buying call options, please don't select any other tabs, we see a lot of data. First and foremost, at the top here is the expiration date. We have chosen March 1st, but as you can see, there are tons of choices to choose from. On the left, you'll see strike price, and on the right is the ask price, which is the options premium, aka the price of the call option contract. Now, let's pretend you buy one call option contract for $12.35 at the $175 strike price. Let's get one thing out of the way. In the options world, one options contract represents 100 shares of the underlying stock. The prices listed for the one options contract just represent the price for one share. Therefore, to represent 100 shares, we need to multiply the $12.35 cost times 100. This means that it will actually cost you $1,235 to buy one options contract. This is the only number you need to multiply by 100 on here. It's important to note that in the finance world, it is generally accepted to just mention the options contract cost as being $12.35, but just know that you would actually have to pay $1,235 for it. Okay, so the strike price is the fixed price that you are able to buy Apple for from now until March 1st. But wait a second, Why can't you just buy Apple for $175 and sell it at its current market price of $185.11 and repeat for an infinite money glitch? Well, not so fast. How much did you pay for the call options contract? $12.35. And how much can you buy Apple for? $175. You spent now $187.35. And how much can you sell an Apple share for on the market? That's right, $185.11. Yes, you just lost $2.24. To completely break even on this trade, you need Apple to rise by $2.24 by March 1st. So why did you just pay this extra $2.24 than you can currently get for the price of Apple today? Well, this is the extrinsic value portion of the options premium. The future is uncertain, and there are loads of things that could happen to Apple between now and March 1st. Maybe they surprise release a new product. Perhaps they buy out another tech company. Or perhaps they get a new CEO. Who knows? The $2.24 basically prices in all of the things that could happen to Apple from now until then. The intrinsic value is just the current price minus strike price, and since Apple is trading at $185.11 and the strike price is $175, there is $10.11 worth of intrinsic value in this options premium. Okay, what gives? Why would anyone buy call options if you would lose money if you exercise this immediately? Well, imagine a scenario where you purchase this call option, then Apple's share price shoots to $250. Since you paid $12.35 to have the ability to buy Apple at any time for only $175, what you can do is say, sure, I will exercise this option by buying my 100 shares at $175. This is going to cost you $17,500, but you could turn around and immediately sell those for the current Apple price, which is $250, therefore generating you $25,000. This is a profit here of $7,500, but keep in mind you originally paid $1,235 for the options premium. So total money in your pocket is $6,265. This is approximately 5x return. The share price only went up about 34% from 185 to 250, but you multiplied your initial investment by about 5x. This is the intriguing part of options trading, leverage. It's important to mention that you never have to exercise call options. You can simply trade the contracts. In fact, it will always be more profitable to do it this way if you choose to sell before the expiration date. If you buy that same contract for $12.35 and Apple's price shoots up to $250 soon after you buy it, then the options contract will also rise in price. This options premium will now be at least $75 since that is the intrinsic value, and then there will also be some extrinsic value added to that because there is still time left to expiration. Let's say this has $5 worth of extrinsic value. Well, that would make the total options premium price to be $80. This would now be a whopping $80 divided by $12.35, or a 6.5x. Selling the $80 options contract would generate you $8,000. Note, selling the call option you bought is different than exercising the option. Exercising a call option is buying the shares at the strike price. Selling the call option you had bought means you never had to deal with the shares, which most people prefer. And keep in mind, the most you can lose on buying a call option is the option premium price. If Apple finishes at $150 at the end of the trading day on March 1st, then you would lose your entire $1,235. In fact, if it finishes anywhere below the strike price, you are going to lose that entire $1,235. Here's a profit and loss graph for a fake stock that had a $5 option premium, costing you $500, and a strike price of $100. The break-even price will be $105, and any price above $105 you will make money on. Any price below $100 and you will lose all of the $500 you initially invested. If the stock lands between $100 and $105 on the expiration date, then you will lose some, but not all of your initial $500 investment. In the next video, we'll get more in depth on options by talking about the options Greeks.